Hi, welcome back to another episode of our City by City Market Pressure Review series. I'm Junge, the Senior Research Analyst here at InvestorKit. And today we're looking at Central Coast. Central Coast is technically a part of Greater Sydney. However, the market cycle there is slightly different from the Sydney metro area. That's why we're considering it as a regional market for this series. Central Coast house prices started recovering in 2023, but now the growth is still not very fast. So, what's going to happen in Central Coast in the end of 2024 and in 2025? Let's try to find out today with 10 charts. But before we get into it, if you are a property investor who's interested in analyzing the property market with data, you're at the right place, because that's what we do at InvestorKit's research team. If you like today's video, please like and subscribe. With your support, we'll be able to create more content like this and deliver them to you more frequently. So, Central Coast in 10 charts. In these 10 charts, I'll be covering the demographic and economic trends, the trends in its sales market and rental market, both in the short term and in the long term. And if you're curious about where Central Coast is going in the coming 6 to 12 months, stay till the end where I will share with you our prediction on Central Coast's growth in the short term and in the medium term. So now let's start with the first chart. The first chart we are looking at here is an overview of Central Coast's market performance. Overall, we say Central Coast's market pressure is balanced. Incoming supply is scoring really high, 5 out of 5. That's because we see really low oversupply risk there. Rental pressure is 4 out of 5, relatively high. We see healthy rental growth in the coming year. Price pressure is just balanced, 3 out of 5, while rental yield, affordability, and growth cycle all scored just 2 out of 5, relatively low. And I will be explaining to you why they scored low. Now, chart 2, the migration and population growth trends. In the few years leading to the pandemic, population growth rate has been going down. And last year, the growth rate has finally improved. Although the 0.9% rate is still relatively low if we compare that with Australia's average level of 1.9%. That recovery was primarily contributed by the surge in overseas migration and the recovery in internal migration. Speaking of internal migration, it's interesting to see that the loss of internal migrants is primarily happening in just Gosford, while Wyong's internal migration is basically balanced. So the population growth in Central Coast is recovering, although the actual number is not really high. We hope the recovery in internal migration could continue so that the population growth can give more boost in its housing demand recovery. So now let's have a look what's happening in the local economy. Unemployment rate is really low at just 3%, and that is around the lowest level in over a decade. Same thing in the number of job opportunities. While now the number of job opportunities is much lower than its 2022 peak, but compared to the last 10-year average, we're still seeing a relatively high level. Both of these indicators are indicating a much more active job market compared to the previous decade. That is a good thing for the growth of its property market. Now, what's happening in the property market? You might have remembered that we were saying the market pressure in Central Coast is balanced. We're seeing that in three aspects. The first thing is the actual price trends. Over the past year, Gosford's house prices increased by 8.4%, and Wyong's house prices increased by 5.8%. These two numbers are slightly higher than the long-term average, but One, they're lower than Greater Sydney's average growth, and two, compared to the other regional cities, especially those in Queensland and Western Australia or South Australia, they are still relatively low. And the second data point that's showing balanced price pressure is the days on market. Yes, compared to last year, the days on market now is lower, but ever since early 2024, it has been staying at around 59 days, almost half a year without moving. We would like to see further decline to be able to say that the market pressure here is increasing. The third data point where we see just balanced market pressure is in inventory, or the relationship between demand and supply. Over the past year, the number of sales or demand has increased, but at the same time, the number of for sale listings or the supply level has increased as well. So as a result, inventory level has stayed very stable at around 3 months of stock. Moving forward, we would expect the inventory level to stay balanced at around 3 until rate cuts potentially improve affordability and boost demand in Central Coast and break this balanced status. Now, let's have a look at the incoming supply in Central Coast. So, over the past decade, the new house building approval rates in Central Coast have always been around 1%. That is much lower than the usually deemed balanced level of 2 to 3%. So in Central Coast, oversupply almost never a concern for the housing market. One of the reasons, at least, that Central Coast's house values have grown so well in the past decade, which is what we are going to see in chart 7. So over the past 5 years, from 2019 to 2024, price trends in Central Coast have been a bit bumpy, and the overall growth wasn't as good as the other big regional cities. But if we extend the time period to 10 years, it will be a different story. Gosford's last 10-year growth was 142%, and Wyong's last 10-year growth was 132%. That's much higher than the top populated regional cities average, and they're also much higher than the Sydney's average level of 112%. So the extremely high last 10-year growth would probably limit the further growth of Central Coast. By saying that, we're not meaning that it's not growing at all. What I mean is that growth in Central Coast will probably be moderate until the last 10-year growth becomes lower and lower and finally in line with long-term average level. Now, the rental market. Vacancy rate in Central Coast has been largely declining in the past year. Now it's only 0.5%. That is extremely low. So responding to this really tight rental market, Gosford's rental prices have been increasing since early 2024, but Wyong's rental prices are not moving much yet. Given this really low vacancy rates and the tight rental supply level, we expect Wyong's rental prices to start growing very shortly. Rental yields. Rental yields in Central Coast are not really attractive. Gosford 3.2% and Wyong 3.5%. Yes, they are slightly higher compared to the Sydney's yield level, which is just around 2.9%. They are really low compared to the large regional cities average or the high interest rates we're facing now. So moving forward, two things are likely to happen. One is that rental growth will keep exceeding price growth, and if that happens, rental yield will be improving gradually. That is what we are seeing now in Gosford. And the second thing is in 2025, interest rates are expected to go down. And as interest rates get lower and lower, the attractiveness of these rental yield numbers will be improving as well. So these two things combined together, investors will be attracted back to Central Coast. So in the long term, rental growth in Gosford has been largely in line with the other large regional cities, while Waiyan is a bit lagged behind. But as we have seen in the previous charts, vacancy rate is lower, rental pressure is high, so Waiyan's rental price growth is expected to catch up soon. So what we are seeing now in Central Coast is one, population growth is not as fast, but it's improving. Two, the local economy is strong and is providing the property market a healthy foundation. Three, the price pressure is just balanced. That can be seen in the stagnant days on market level and stagnant inventory level. And four, price growth is limited by the affordability and the extremely high last 10-year growth. And then five, rental market pressure is relatively high and rental yield is expected to improve as rental prices outperforms the sales prices growth. So, in conclusion, in the coming 6 to 12 months, we would expect Central Coast house prices to continue the current moderate growth. But in 2025, when interest rates start to go down, several things will happen. One, affordability will be improved. Two, buyers' sentiment will overall improve. Three, rental yield, although still relatively low, will become more attractive to investors. So when those happen, Central Coast house prices will start growing faster and the region will enter what we call a second wind growth cycle or second wind growth phase. So that was Central Coast in 10 charts. I hope you like it. If you're interested in more content like this, check our channel or the InvestorKit website, where you'll find more podcast shows, blogs, white papers, and more. I'm Junge, the Senior Research Analyst at InvestorKit, and I'll see you next time.